Every time they go to a meeting, they go with a present. Every time that I was going to the United States, and every time that I was going for a meeting with a GP, I was coming with a bag of the best coffee in the world. They always remember me as the guy with the coffee bag, you know?
Superclusters is where we demystify the secrets, stories, and tactics behind the money that moves the venture capital world. Excited to have Felipe on Superclusters today. Felipe Valencia is the founding partner and chief investment officer at Veronorte, which boasts a portfolio including the likes of IVP, Menlo Ventures, NFX, Reach Capital, and XYZ, just to name a few, but also into emerging and frontier funds, both of which the terminology we'll dive into later in this episode. He's held a slew of titles across the years, from mechanical engineer to commercial attaché to now LP, just to name a few. And we call such individuals polymaths. And that's not even counting the 10 cities he's lived in across 4 continents. And that's 3 more to go. I want to thank my buddy Enzo Cavalli at Reach Capital for the introduction. Without that, this episode would not have been possible. And we cover a lot of ground here, and there's 3 areas, I think, in terms of chapters for this episode that would be really interesting. 1, how Felipe grew up in a terror-torn Colombia. 2, how do you transition from a VC fund into a fund of funds? And what does that process and the rationale need to look like in order to get buy-in not only from your existing LPs, but also future LPs? And third of which, why a fund of funds is allocating 60% into established managers, 30% into emerging firms, and 10% into frontier funds. All of which we'll get into, but so many spicy takes, lots of good mic drops, and we've got a packed schedule ahead of us. But without further ado, Felipe, welcome to the show.
Hey, David, thank you very much for having me. It's great to be here.
I am so excited for this because last time we were sipping tea and we were talking about everything podcast, and I was learning so much in that conversation. And I was like, holy cow. And I mentioned this in our pre-chat as well. It's like, I've got to get Felipe on no matter what. And so we'll leave time for all the LP VC stuff. But I want to start back in childhood. I want to start back in time, specifically in the 80s and 90s. So most people might remember that period of time for 80s and 90s categorized by, space shuttle launches, Metallica, Guns N' Roses, but it was different for you. So if it's all right with you, and if that's a good lead in there, I'd love to start with, what did the 80s and 90s look like for you?
So David, yes, it was happy times, happy moments, but difficult as well. And I'm from Medellin, Colombia. I still live in Medellin, Colombia. And I grew up during a time where my city was considered the most violent city in the world. And it was the war against the Medellin cartel and Pablo Escobar. And it was difficult because we had several bombs per week. And they were putting bombs in randomly places, like, shopping centers or in a park, or, it was not a targeted attempt for the, police or army. It was terrorism. So that was difficult. But even worse than that is that my dad, who was a public servant, a public officer, on that time was second, I will say, on the position in the local government, and he was in charge of the security and the safety of the city. So it was very difficult because he was in the front line. And I remember being scared at night. I remember seeing my dad very early in the morning before I wake up, going to my bed, talk to me while I was sleeping or pretending I was sleeping, and he was saying goodbye because he didn't know he would be killed that day. And so that was difficult, but I also saw a lot of determination on my dad to do the right thing, to work for the city, to serve public. And this has something that has also had an impact in my life.
It's a very dangerous time. At the same time, you never know when bombs could go off and, terrorists could come in effectively. Did your dad say anything to you or the family to help comfort? Because I imagine when he comforts you every night and almost as if he's about to say bye-bye, it's like, it's a scary notion to even think about that I might not see someone very close to me the next day. Were there any words of comfort that he helped say to the family that helped you through trying times?
David, I have these type of conversations with my dad, 30 years after. Now we are both grown ups, of course. I was like 13 during that time. So it was my early teenage times, teenager times. And my dad was fully determined to work for the city, to fight that war, to go and work every single day. It was times in my city where you cannot go outside your house after 6 p.m. in the afternoon. But he was going out because he was in charge of, the security and the safety of the city. So, but he was so confident of what he was doing, and he seems to be having everything under control, that in some cases, even though if he didn't feel it, he gave us a lot of comfort that the situation was controlled. That was not the reality. The situation was not controlled, and he was really in the front line. But we didn't know. My mom did. And that was difficult for her. There was a time, I don't know, 1 year, 1.5 years, that my mom didn't allow my dad to go with us in the car.
Oh, wow.
So, for example, if we were visiting our grandmother, my dad who always said, I have to go and pass or swing by the office because I need to get something. I meet you there. And the whole reason why he was always doing that, what we never noticed, is that my mom forbid my dad to go with us in the car because it was an attempt. If there was an attempt, we will be on the shoot line as well. So for my mom, I think it was really difficult. But I also learned that from her, that she asked my dad, "This is what you want to do with your life, and you're risking also our life, and that your children won't have a dad. But this is what you feel, this is what you think is your duty. We respect that, and we will support you. But we have to take all the measures in order to, keep our family as safe as possible." So this is how we saw it. And when you talk to him, he was so into the duty, into the work, into the mission that he has to accomplish, that in some cases he was not aware of the real risk and the impacts that you can have in children and in the family of living in such condition. It's like people get into the mission, I will say, and they were absolutely fixed on solving the problem and, move the city and the society forward in these difficult times of Colombia and especially of Medellin.
I'm curious, and you can leave this up to speculation, but I imagine you'll have some context here, which is, what do you think motivated your dad to do what he did?
I think that he has a very deep and a strong sense of serving society. And, you get into a position of power, and there is a difficult situation, and somebody has to play that role. Somebody has to do it. And he and a bunch of colleagues and friends were in that position, and many others in Colombia that were killed and some others were not. But at the end, somehow we succeed of surviving and improving the conditions of the city after these difficult times. And if you come now to Medellin, it's a total different city. Right now, Medellin is becoming a very hot spot for tourism. And we have becoming now the second largest destination of tourism in Colombia after Cartagena. And is very popular and is very safe right now compared to what it was 20, 30 years ago.
I'm curious. This is something that I wish I looked more into, and probably should have done my homework on this. But what did that transitional period look like from a tumultuous time to the blossoming tourist beautiful city as it is today?
Oh, this has been a long process because
Right.
it's not just the cartel and that times. There were also difficult times with the guerrilla and with the paramilitaries in this city and in this country. And we still have a lot of problems and challenges. But the city has changed a lot. And one of the things that have changed is the cartel as an organization was dismantled, and it ended with Pablo Escobar killing.
Mm-hmm.
There's still, of course, this problem, but it's not an organized group of people who have the goal to attempt and to fight a war against the establishment and the government. That doesn't exist anymore at that level. And Medellin has been suffering a transformation that started also with a lot of infrastructure and cultural changes. And the city has been recognized as one of the most innovative cities in the world because of the, urban innovation of how we can change behavior of people, but investing in different areas of the city and connecting those poorest parts of the city with the rest of the system. So we still have a long way to go, but if we compare to the Medellin that I lived when I was a teenager, it's a total different city, and it's very fun. It's great. I think it's one of the top 5 destinations for digital nomads right now. So we see a lot of young people and entrepreneurs and coders, and you don't even know who is who. It's like when you go to Silicon Valley and you sit in a coffee shop and you don't know who is next to you and what type of entrepreneur or what they're working on. This is happening in Medellin as well, because they might be working for the same company, but from Medellin.
I had a couple former colleagues that when we were working together, they were nomading and they were spending a lot of time in Colombia as well. And I also have another friend of mine who started hosting, like using Colombia as the hotspot to host kind of like founder meets VC meets LP summits. And these are like 3-day summits, and it's gotten a lot of attention as of late as well. So I've heard so much about it. I have yet to go myself, but that is definitely on my priority, like my bucket list to go to. To switch gears here, because you spent your early life in Colombia, and then obviously you are still in Colombia, but there's this gap in the story where, as we mentioned at the very beginning, you lived in 10 cities across 4 continents, still missing 3, but 10 cities over 4 continents. What did that look like? Were you wanderlust, and were you looking to spend time outside of Colombia, or was it just a forcing function of the job?
No. I think it was an internal desire of go and live in different places, meet different people, different cultures. I always have had this gypsy soul of going and live in different places. And when I finished school, my undergrad school, I went to work for a company in Los Angeles. Before that, while I was in the school, I had the opportunity to go for exchange as a student in Germany, because I studied in a German school. So I started traveling solo early on. My first time going to Europe was when I was 13. And I don't understand why my dad, who comes from a very poor part of the city, he was not a person of means when he was a child. His house didn't have floor, for example, or he were not wearing shoes to go to school every day. He came with the idea that we need to know the world. And since we were very young, he pushed us to go and visit other countries, do different experiences. And as I told you, I left for my first trip solo to Europe to visit a friend who was living there when I was 13. And then when I was 14, I did it the same. And then 16. So I grew up with a very Colombian culture. I have a very strong root in terms of culture and tradition, but with a global vision of the world because I was traveling and living, not just as a tourist, living in places since I was really young. So when I finished and I could decide by myself what to do, I started working in a company in Los Angeles. So that was my first professional experience. I was a mechanical engineer that I specialized in robotics. So I went to a company to design and build robots for theme parks and special effects for the movies in San Fernando Valley in California. And then I went to Germany to work for a research and development department at Siemens in mechatronics. And I didn't want to come back. So I found out an opportunity to study web communication in Rome. I went to live in Italy and I spent 2 years there. I worked there as well. I came back to Colombia, but to Bogota, not to my city. And after 1.5 years, I say I want to go and continue traveling the world. So I applied for a position in Beijing, in China, for the government, working for the Trade Promotion Office of Colombia in China, that I started as the first, director. And I lived in China for 3.5 years. Then I moved to Mexico with a different company. And before coming back to Colombia, because I did have the idea of coming back and, and start a normal life and get married and have kids and start a company, I stopped in Chicago because I did my master's, my MBA at the University of Chicago Booth School of Business. And that was an incredible opportunity for me to learn more about business because I was a mechanical engineer. I was more in the technical part. And then I moved more to international commerce and I started getting into investments or investment promotion without knowing very well, the mechanics or the science, if we can call it science behind it. So it was a great experience. And there is where I started thinking of doing venture capital.
Hold up. I'm going to how did you go from business to venture capital? Because business, like Chicago Booth, phenomenal school, right? I like in my mind, and this is the story I'm repeating in my head. It's like, if you went to Stanford, it's like, it's the heart of Silicon Valley, venture capital is everywhere. And so it becomes a very natural path for like Stanford GSB individuals. If you're in Wharton or you're in Columbia, like the natural is you go to Wall Street, you go banking, consulting, that kind of world over there. How did you make that leap of faith between you're learning more about business and all of a sudden into venture capital?
So yes, when I went there, I know that it's Chicago. I loved economy and economics.
Yeah.
So I get to learn more about what I didn't do during undergrad because I was a mechanical engineer in terms of learning more about economics, sociology, because there's a lot of that in Chicago as well. I'm not very into finance. So I came to venture capital without passing through the, finance path. I have never worked as an investment banker, evaluating companies and doing this type of corporate finance job. Never. This is my partner, Camilo. But I love technology and I work in technology for my whole life.
Uh-huh.
And also I had this sense of working for my region and for my country. And I was in Chicago. So I figured out that combining technology, this sense of how can I add, how can I help to build a better society and a better economy for the region and for my country. I saw that venture capital could be a good opportunity of combining all of that. Like, coming back to Latin America, starting doing venture capital, helping companies or innovation to spark out of this continent. And then I decided to take every single class in, private equity, venture capital, innovation out of Chicago. And I came back with the idea of creating a venture capital firm out of Colombia. It was 2011. So it was a long time ago now.
This was very prescient because this is still admittedly very, comparatively early on in the grander, even US adoption of venture capital. I want to say this is 2011, still before like Eileen Lee came up with the word unicorn. This is early days of a lot of like the A16Zs, the cowboy ventures and all that. So it's still relatively early on in the curve and probably only like a couple hundred at best venture firms in the world.
That's true. Yes, but because you were exposed to that, even though if I were not in the Bay Area, not in Stanford or in Berkeley, we did have a lot of exposure to venture capital. There were a couple of professors there, Steve Kaplan, who is an amazing researcher on the asset class, and Scott Meadow, a practitioner who became my mentor during this time. And I remember his last class, he said, if you are not from the United States and you want to get into venture capital, I encourage you to go back to your countries and start the industry there, because the all good days are already past here. He said that. And you're going to create your own good days by starting the industry. And I took the advice and I came back to Colombia with the idea of doing something in venture with no track record, no experience, no money.
Right.
And after living for more than 14 years outside my city.
So many questions. I like for the sake of time, we'll jump into the venture capital portion, but for our listeners and our viewers, this is a good set of like, we're going to leave some things intentionally hanging as cliffhangers that you got to follow up with Felipe on, in terms of like, after 14 years, this, in my mind, what this is the Luke Skywalker going back to Tatooine. And like, he's gone on his hero's journey around the world, or the galaxy, and he's gone back to Tatooine. He's like, I'm gonna settle here for a bit. So that's what it reminds me of. I want to go back to like, the inception of Veronorte, which is probably around that period of time. I think maybe the inception might have been a little later, but you actually spent some time in ventures and a couple other places as well. Let's start with, how did you meet Camilo? How did you meet him? Because as most people start their relationships post-professional career, post-graduation, your relationship with Camilo actually dates further back. And I'm curious on like how you, one, built that friendship, and then two, how you maintain that friendship over time, when by the time you decide to start Veronorte, you're like, I've got to do it with my buddy.
And so Camilo and me, we have been friends for more than 30 years now. So we were in high school. We were not at the same school. And we had a good friend in common. Actually, it's my cousin. And he introduced me to his group of friends. And they were very open to adopt me as a foreigner from another school into their group. And they became my best friends. We are a group of friends that we are friends for life. And Camilo has been a real good friend. But not only that, Camilo is an amazing professional and very smart, very intelligent. So now when I came back from Chicago and thinking of doing something in venture capital, the only thing that I had really clear is that it has to be something different of what I have seen or studied in the United States, because circumstances and the whole culture and the whole market was totally different. And I took 6 months when I came back just to talk to people, understand what to do, what not to do. I was a little bit naive of trying to do venture capital during that time in this country. And one of the person that I, reach out to talk about this and to help me think how to do it was Camilo. So the first couple of sessions where Inventure was born, because Inventure is Veronorte's previous name, but it's the same company. So was thinking, how can I do it? What can I do it? Where are the opportunities? Camilo did his research when he was graduating from undergrad on venture capital. And then after that, he did the whole, banker career, investment banker career. And he had on that time a very high position in one of the largest corporations in Colombia and in Latin America. So he got very engaged on the conversation, the opportunity. He was also in his personal process of thinking in, switching gears and doing something for his own, creating a new company. And when I came in, we start talking, and after the second or third conversation, he said, I would like to do this with you. Let's do it together. We didn't know what we were going to do, but let's do it together. So he said, I'm going to quit my job. And I say, no, don't do it. I'm already jobless. So let me continue thinking of what to do. We can think together. And whenever we have something more, clear, you can quit and we can do something. We can execute something. But after a few months, he got, desperate because his mind was already in another place, and he quit, and we started working on creating a venture capital firm out of Latin America.
To harken back to something you mentioned earlier, as you're building that venture capital firm, and as Camilo and yourself are like, this is our full-time thing, neither of you, from what I know, had track records at that point in time. And so what did it look like? What was your pitch to your LPs to be like, this is why you got to believe in us?
Yes, we didn't have any track record. We didn't have any money. We didn't have even the founder track record. Like we started a company, we come from the technology world. No.
Yeah.
He was an investment banker. I was doing many things, as you said, like a kind of a polymath. And we realized really soon, it took us like 1 or 2 years, that we could not do venture capital in Colombia and Latin America during that time. Mm-hmm. And the reason was because we didn't have the track record to raise a fund. But the other thing is that, and we're still very, not concerned, but very, I will say, thoughtful on if venture capital is the right instrument to finance the companies that we are financing in Latin America that we call startups. Mm-hmm. Because the reason is that first, we don't see the same level of disruption, technology. We don't have the same capacity of research and development and technology creation out of these regions, unfortunately. We don't have big markets that are needed to be able to have this type of exits that will create the power law distribution that allows venture capital to exist. And we don't have the whole market or capital market to be able to support a company from seed stage to pre-IPO, not even IPOs. Like it's really complicated. So we figured out very early that it was somehow of naive to think that we could do the regular venture capital model in Latin America. But we did understand that technology could change our reality. Mm-hmm. During this time, we traveled a lot. We went to Silicon Valley a couple of times. We visited Israel. We went to New York. We came down to Argentina and Brazil, who had a more advanced ecosystem. We studied in Harvard, in Stanford, in Berkeley. And we were able to see what this type of technologies can do. Then we say, if we cannot invest in that type of companies in our region, why we don't invest outside our region, and why we don't go to the United States to invest in that amazing startups and technology that we have seen? Because our dollars are as green as the US dollars, it's the same money. It's much less money, but it's the same money. So we came up with the idea that who should be doing this in Latin America? And we come with the answer that the largest corporations in this region, they should be doing this, because if they want to connect with the, edge of disruption, technology development, they should be putting some money and having an eye and checking what's going on in the frontiers of technology. Mm-hmm. So we came with the idea to convince some of the largest corporations in our country and in our region to start investing in venture capital. So what we created is we created the possibility of having an LP, an investor, who has also a strategic objective of doing what we were doing, but outsourcing the venture capital work to us. Mm-hmm. On that moment, we didn't know that the word or the term venture capital, corporate venture capital existed.
Right.
And we were doing it without knowing it. And we came up with a model where large corporations, they put some money from their balance sheet to invest in these technologies. And we emulate a fund, a portfolio. And the reason was how we can connect our reality and our big corporations with those startups and that innovation. So this is when Veronorte was born. We changed the name of the company because we had a totally different approach. And we started working with one of the largest financial conglomerates in Latin America. And then after that, the following years, we managed the funds or the corporate venture programs for two other big corporations out of the region.
What was that pitch to that financial corporation? And were they already thinking about allocating to new company startups abroad, or was this completely news to them?
It was completely new to them. They were doing some kind of open innovation efforts. They had in the past experience of investing in some startups or incubation programs locally. But what we told them, and I think it was not difficult for them to see it, was that there is a lot of disruption happening. Their industry will be disrupted. And this could be a very efficient way to keep an eye on what's going on, but also to create relationships in order to be first movers in the region and, bring technologies, create strategic alliances with these type of companies in their industries with their investment thesis. So what is important there is that we were able to tell them that what we wanted to help them to build their own program. So we never saw it as our funds. We saw it as their programs. Mm-hmm. So we built the investment thesis together with them, with a lot of workshops and understanding the companies and their vision and their strategy. And then we became part of their team, but we had the capacity of flying solo and being nimble and flexible. That is something that you need to do venture capital.
I'm curious, could you walk us through the scaffolding of what that looked like? How many meetings did it take? Who did you meet with? How did you arrive at the number for them to allocate into a venture fund effectively?
So actually, when we started very small. And at the beginning, the program was called Veronorte program in alliance with the name of the corporation, very small, because there was a lot of risk.
Yeah.
And we started, and actually we started looking for opportunities in Colombia and in Latin America, because they told us we have to do the homework of looking what we can see in our region, and then we can go outside the region. And our first investment ever was a local company, but that was the only investment we did in Colombia. Mm-hmm. So we started little by little. Then we started telling them and educating them that this is a portfolio game, that we need to have a portfolio approach, because the only way you can bear the risk in venture capital is by diversification.
Right.
So then they start getting more confident. So we build little by little the confidence, the trust, the capacity, and it ended up becoming a significant fund for us. And after having that, replicating the other two was easier because they saw that it worked.
Right.
We were able to invest in great companies, but not only that, we were able to connect for collaboration or for, contracts and real business, more than 50% of our portfolios to the Latin American region. So we were really bringing technologies and creating that bridge between, the innovation ecosystems in the United States, a little bit in Asia and Europe, and the reality of Latin America. So it was easier after that. But at the beginning, it was trial and error. We were learning. We were flexible enough to come up with the model that I didn't see it before in the US when I was there studying at the University of Chicago. We came up with our own model.
I have to ask, what was the model?
So the model was that we emulate a fund, but we were pulling money from the balance sheet.
Uh-huh.
We did have a target of the money we wanted to invest, so we can create a portfolio. So we have a portfolio construction strategy. And we had kind of a management fee. It was an open book management fee. So it was a budget-based management fee. We were not making any profits out of the management fee. We were showing them how much does it cost to operate what we were doing, and they were covering the expenses. And we emulate a carry structure. So a carried interest on the portfolio. But all of the heavy lifting was made by us. So we got all the trust from this corporation to represent them as investors in the venture capital world. So we were, co-creating with them the investment thesis. We were sourcing. We were doing all the evaluations and due diligence. And when we have everything ready for an investment decision, we brought the investment decision to the investment committee together with the corporations, and they were making the final decisions to invest in or not to invest in a company. Gotcha. So in that sense, having a corporate venture program where you outsource part of the process could be very beneficial for doing corporate venture. And we always had a financial objective in our head. So our incentives were financial. Right. We did have a little bit of the capital that we were at the beginning putting ourselves, and then we raised some little sidecar fund with some families locally. And that is very important in corporate venture, not to forget that this should be a financial play, and you have to make money, not because the corporation is looking to make money necessarily, but because the discipline that you get of evaluating the investment opportunities as a real investor that is looking for profit and for returns is very important to choose wisely. Not only the companies that fit the thesis, but can, be successful and be a good partner in the long run and bring more value because they will be successful as well. So this combination, I think it was really, really successful.
I have two questions to follow up here, and I promise our audience will get into the LP stuff in just a bit. But as two follow-up questions, one, you pretty much the management fee was like a break-even open book management fee, as you mentioned. Part of that fee includes both you and Camilo's salary, and I'm curious, and this is something that probably and I don't know if this is too forward, but I'm sure a lot of our audience would also be really curious. What is a good number to think about paying yourself when you're just starting off and trying to build track record and build strategic value to an L?
At the beginning, our first approach was, let's do this together. Let's put money both, the big corporation and our little startup. So at the beginning, I had a very small salary, very discounted salary. And because I was putting money also for the expenses of the whole program, the net was that I was putting money to work every single month. And we did have a low salary for many years, but we were investing in our firm. we didn't have the track record. We were not successful entrepreneurs that sold a company, Mercado Libre or something like this. And we had to pay the price. And this corporation gave us the opportunity to start doing venture capital. I started my career in venture capital being a partner of my own firm. So this is crazy, but there is a price, and the price that I was not, paid as a, partner on a established firm right now. But this also showed the commitment that we had and the vision that I think is very important for emerging firms.
Yeah.
Is that we showed that we were for the long run, that we were building a firm, that we're going to be here for the long run. And when you are doing investment that are going to take 10 years to mature, you need to see that commitments in the key people and the managing partners or the GPs.
That's fair. And then, so in terms of the rationale that you have in your mind, did you say like, hey, you know what, I'm making this number up, but I have 24 months of a runway because of my previous roles, and I'm giving myself like a 2-year runway to figure this out. Otherwise, I have to go figure out something else. Or did you find other means to, because you were getting, in your words, like a minimal salary? Like, how did you make ends work?
is the first thing. But the one who came with that alarm was Camilo. Camilo is the structure guy in this partnership. And Camilo say, hey, I have this amount of time. This is the runway that I have with my personal savings.
Yeah.
If we cannot do something and we cannot put this together and grow it in a way that it will allow us to have not a high salary, but at least the salary to cover our expenses, we cannot continue doing it. And at the end, it worked out. I remember during that time, Camilo become father. So it's
that's an increase
difficult.
in expenses.
Yes. And not only that, the perspective that you have on the future,
right,
it makes you do something more, you become more conservative.
Right.
And I think that it was good for Veronorte that Camilo become a father during that specific time, because gave him the perspective and the need to tell me we need to nail this down.
Right.
And to be able to grow and to create a real firm that can give us the possibility to have a good life.
I'm curious, like, if you can put a number on that. What was that runway? Because I know from like a previous episode, to buy you some time here, Jaap Rissendorp, season 2, he runs this firm called Market Link Capital. He and his partner gave himself, Bauka, like a year. He was like, we have a year of savings. We either make this work in a year or we're figuring something else out, because they also came from the consulting life and all that kind of stuff. For you and Camilo, what was that time frame? What was a reasonable time frame that you both gave yourself?
I cannot remember. I think it was something between 1 and 2 years when we had the conversation. For me, it was easier because I was single, and I came back and I was living with my mom. So when I was a teenager, and expenses for me were not that hard. But when you get into that comfort zone, you need some fire in order to be able to move things faster and to do bolder decisions. And Camilo brought that sense of urgency during that time where we were starting the firm.
I feel like there's a common thread here of like phenomenal LPs starting their early days, living with their parents or having that as a plan as well, because we had Abe Finkelstein who now runs Vintage Investment Partners, season 2 as well, and he started off, he's like, you know what, I graduated with a business degree from Wharton, one of the best schools out there, and he had to live in his parents' home when he graduated from that, and he like did a bunch of odd jobs, sales and a bunch of others, to eventually arrive at being an LP. And now Vintage is a phenomenal fund of funds and secondaries and all that as well. And even so, like,
David, and I was 35 already. I was not young.
So there's a lot of like probably like social pressure as well. That I was there social pressure that you were feeling?
No.
Okay.
No. And I knew it was temporary, but it was great. And also after living so many years outside your house, spending time with your mom or your dad, is always great.
There's a great blog post by this author by the name of Tim Urban. He writes this blog post called Wait But Why. And the specific blog post I'm thinking of is this blog post called The Tail End. And you bring up, like, having been away from home for that long, 14 plus years and all that, you finally go back home. It's actually nice to see parents. And I say that because in that blog post, he categorized like, oh, here are the number, like, instead of counting how many years you're going to have yet to live, count how many Super Bowls you're still going to see, or count how many Olympics you're still going to see. At the very end of that blog post, he's one of the key metrics that stood out to me was by the time you turn 18, for most people would have already spent 90% of their time with their parents. And it's such a crazy metric to even think about. And so even for myself, like, I love spending time with my parents because I constantly think about this. Like, I only have like less than 10% of my time left with my parents. I want to make sure every minute, hour, day, week counts, even on vacation and holidays and all that.
Yeah, that's true. But on the other sense, Latin American is different, and we are very family oriented.
Okay.
So
this might be a US thing.
Yes, it doesn't feel that bad that you're still living with your parents if you are in a transition mode or you are older. People here live with their parents for longer than in the United States. But I agree. Spending times with the family, with the parents, is very important, and I think this is like a solid ground for the rest of your life. Having a good relationship with your family and especially with your parents is very important.
I agree. So switch gears and to fulfill a promise back to our audience, I'd like to talk about the LP side of things because Veronorte, as it stands right now, is now a fund of funds, not a venture fund. And I want to say that the inflection point, and you can correct me if I'm wrong on the timestamp here, which is about end of 2022, so about Q4 of 2022. You were at a crossroads around Fund 4 of Veronorte, and you were deciding, should you do a venture fund or should you do a fund of funds? And as someone as I know, and if it didn't come across already, you are an incredibly intentional individual with each decision in which you make. So from portfolio construction to, and I remember reading, to building a Monte Carlo simulation model of what that looks like to better understand the odds of allocating to multiple venture funds. Could you walk us through the behind the scenes of what it was like to transition from, now that you finally built up a track record as a venture fund, to now doing something completely new, which is a fund of funds?
Yes. So, David, the reason why we started thinking of this was, I think that there were three main drivers. Number one was that the corporate venture, exercise that we were doing started to show that there were some flaws in our model, in terms of how we align incentives with the corporations, how we can continue investing in companies, how we can grow and create new funds with the same approach. So we felt the need to come up with something that gave us autonomy. And we started thinking of that even before the pandemic, I remember. And we put in our board, in our office, different alternatives. And since then, one of the alternatives was fund of funds. But we always thought, like, when you do these, strategic exercises, like, what are the assets that you have? And we have a good relationship with different US funds and venture capital firms. And we say, maybe we can do something with that asset. So we put it there and we keep it there. We ended up not continue doing corporate venture for different reasons. Some corporations decided not to continue with that because there is always change in the corporate level. So the CEO, the CFO, everyone changed in a corporation, and they decided to come up with a new strategy. During the pandemic, one of the corporations decided not to continue doing that because they got in difficulties with cash. So cash was not for doing venture capital bets, for the long-term vision, and some other, situations put us in a difficult position that we didn't have assets under management anymore. We didn't have firepower to continue investing, and we had to come up with new solution. And the easiest one and the natural one was, let's do a venture fund. Let's raise the money. Now we can raise money from LPs in Latin America, and let's continue investing into companies. And it was 2021, 22 that, it was a big,
it's a correction in the
big
market.
Party even before that. So it was like, wow, yes, I can do a venture capital fund.
Oh yeah, no, like 2020 and 2021.
On funds and 21, but we saw the correction coming.
Yeah.
And we ask ourselves, okay, if we get the money, how are we going to really win, our stakes in very competitive deals in United States, being in Colombia? We were not seed stage investors when we were doing corporate venture. We were more, I will say, we transitioned from being Series B, Series C investors to Series A investors at the end. Mm-hmm. But if you take like an average, we were Series B investors. So we were not really early stage investors.
Right.
So in order to be there, you need to have a lot of money. You need to, come up with dry powder to maintain the position. And you need a big fund in order to be able to play that game. And we saw that it was going to be very difficult to raise that money because we saw the correction of the market and the situation, especially in Latin America, where we always thought that our LPs are going to be. And we also saw that it was very difficult. We foresee that we saw that the market will get into flight to quality state where the best companies will look for the best funds, and we're going to have a big risk not being able to enter into these great companies because we cannot outcompete a US, established fund. So we came out with the idea why we don't try and why we don't test the hypothesis of doing a fund of funds. And if the best companies and the best technologies, the best entrepreneurs will go to these best investors, best funds, let's be part of those. And this is how we started thinking of creating the fund of funds. And we ran tests, we ran hypotheses, and we try it. And this is how we ended up pursuing this new strategy for us. Which,
for those that are curious on the actual mental models and the analysis that went into that, I'd highly recommend, for those who don't speak Spanish, would recommend Google Translate. But you wrote on your Substack, I think the title of that blog post was, I'm going to butcher my Spanish here, but like Fondo de Fondo es una estrategia or something like that. And I think it's like translated to English, because I don't speak Spanish.
It's fund of funds is a winning strategy.
There we go. And that's exactly what it is. And you literally lay out 5 scenarios of like, there's actually, speaking of diversification, I believe scenario 3, and that was like the power of diversification. You found that actually diversification netted you less than what the current Veronorte strategy is. And so would highly recommend that. There's tons of numbers and all of that, but it's a juicy piece. But
we can upload it in English as well.
Oh, that'd be great.
We have it in English. Actually, all our written communications internally are in English.
Oh.
Only this Substack is in Spanish because it's intended to communicate with the LPs and potential LPs in Latin America. But we do have everything in English as well. I think it's a great idea to do it in English.
You should, because it is so well written. And obviously this is Google Translate, so, play with it what you will. But like, when I read it, I was like, this is so well documented into thinking through, like, here's the scenario analyses, here's what the standard deviation looks like, and here's what the average return can be depending on each strategy. You have like 5 different strategies here, but like depending on each strategy. And the one you found out the best was like, you just have to have high conviction bets into the best funds. So I want to talk about 2 things. One, speaking of LPs and Latin American LPs, I want to talk about that. The second of which, I want to talk about portfolio construction and how you arrived at what you did arrive at. But let's start with the Latin American LP part first. You obviously, if people couldn't tell already, know the corporate venture capital landscape, or the corporate side of the world, Latin America, very, very well. And also now, I believe, I don't know if we can bleep out this number if you want. We want to bleep out this number, but 70%, give or take, of your LP base is like financially driven individuals and family offices. Could you give a lay of the land of like how typically do people who, let's say the family offices in Latin America, how do they typically think, and how do you usually engage in that relationship?
So, David, I think that what you're saying about that specific piece of research or white paper that we wrote, Camilo led that effort and together with the team, is very important, because for the challenge for us is how we can educate Latin American investors about a totally new asset class that is normally understood as a very high risk, disproportionately risky asset class. And people don't understand how you manage risk and all the, the characteristics of this asset class. So the best way we found it to do it, and as I told you, Camilo led this study, is let's take all the venture capital funds that we could get information on. And you have one bullet, and you have to invest that piece of money only in one fund, randomly. When you see that dispersion, is not a normal dispersion, of course not. And the average of the return that you're going to get is exactly the same as the Nasdaq during the same time. So it doesn't make sense to get that risk, to bear that illiquidity for so many years, for 10 years, in order to get the same as you can get in the public markets. But even worse than that, there is a lot of funds that do less than that in terms of returns. Yeah. And very few of them that are doing amazing returns. So the power law distribution is also present in the venture capital business in fund levels. So what we said is that this doesn't make any sense to make just one investment in one fund.
Right.
Then we told them, and it's even worse, because those guys that are doing great, that move the whole average up to the Nasdaq level, all those guys are not accessible to you, because all of them are oversubscribed. They continue to be successful. This is something that happened in venture capital. It's not like in the public markets. It is a virtual cycle that
yes.
If you are successful, you start getting more money, better people, better access to great founders, etc., etc. So those firms continue to be the same. So you cannot invest in that portion of the market if you are not well connected. You don't have access. If you are not there in the ecosystem. So the probability for you to not even outperforming the Nasdaq index is almost 70%. So it's very stupid to do it. And then we say, okay, let's try to do the same, but let's build portfolio of 10 funds, like a fund of funds.
Mm-hmm.
And we saw that with that, we continue to have the same average, of course, but the dispersion of returns were a lot smaller. So what we were trying to show is that diversification is a good way to control for dispersion of returns. And then we say, okay, let's try to invest in funds. So we did a Monte Carlo simulation, as you said. Let's do the simulation that you invest in firms that have had at least one fund in the top quartile, at least one of their funds in their history.
Yeah.
And then you see that the average return moves to the right significantly. And then we did an exercise that a good friend of mine, who is an amazing allocator out of Next Legacy, told me, like, build your wish list and build the list of funds that you can have access to. The ones that you have already connections to because of doing 10 years of venture capital and co-investing with them in the US, but also the ones that you know that you can have access to because somebody can introduce you to them. Right. So we create that menu and we say our fund of funds will come out of this list because we don't know more people than that. And the people that we know can connect us to these people. So we did a very thoughtful exercise of trying to understand how is our network. And then we create the same simulation. Let's do a 10 fund of funds only out of the funds that we have access to. And let's see how this return will look like. And it's even higher than the previous exercise of doing venture capital firm with at least one top quartile fund. So this is how we show LPs or potential LPs that the fund of fund strategy for a region like Latin America and for our reality is a very good strategy to get into venture capital and have an amazing risk return relation when coming out with this type of products. But you need to have the access. If you don't have the access, you have nothing.
Well, like 2 points I want to bring up. One's more of a comment, and the other's more of a question. One is that's actually a really astute point. If at least one of the fund in that firm is a top quartile fund, that subset is at a higher like average and tighter standard deviation than the NASDAQ. I think it's really interesting to even think about just like established firms or like, firms that have at least have recognized excellence in one fund or another are more likely to be excellent again, so to speak.
Yes, because, what we wanted to show them is because when you have investors, they are sophisticated investors, but they have never done venture capital before.
Yeah.
And if they see the public markets, it's very difficult to beat the market, in a big portion every single year. It's very difficult. And it's not, you can easily access the same stocks as any other investors in the world. It's a public market, of course. This is the definition. So to show them that being successful is a signaling for further success because there are specific characteristics of this asset class that allows you to get better and to have better probabilities of better returns when you are already successful.
Yeah.
This was important for us. And I think that with this exercise, we were able to see a little bit of that effect.
I'm curious, and this might be a non sequitur, which is, let's say the public markets do on average, like, I don't know, anywhere to 8 to 12% a year, and then let's say 10% on average kind of thing, right? Venture capital, obviously the IRR underwriting is like what? I think on average 25%. For some fund to funds, it's 30%. In your mind, what is the premium, the minimum premium that is necessary for venture capital to perform on a year-by-year basis to warrant the illiquidity across multiple funds?
So when we were designing that, take into account that we were coming with a very new product for an ecosystem of investors that are not used to do venture capital. So we came up with a fund that it was like a very good 101 venture capital strategy.
Yeah.
So we have established funds. We have late stage funds in our fund of funds. We were like creating like an indexing the best of the different buckets in venture capital.
Yeah.
But we are also controlling for risk. So it's a risk return question. In our sense, something that should be between 17 to 23% IRR net of fees for 12 years, that is the life of a fund of funds, is something that it could be very interesting, at least in this part of the world. But you can design a fund of funds where you only go for emerging managers and you are trying to get a higher return with a broader distribution of returns. There is no free lunch in economics, but you can design. The good thing about venture capital and the fund of fund strategy is that you can design the type of risk return profile that you want. If you are consistent, disciplined, and you really understand the difference and the nuances between the different firms. And I think being co-investors, being venture capitalists for 10 years allow us to understand that by being together with those guys for a decade.
I want to put a pin in that because that leads into the portfolio construction discussion, but I want to wrap up this like strategy limited partner kind of discussion first before we get into the portfolio construction side, because I think that's a very interesting conversation altogether. I'm curious, you mentioned access, and at some point, once you have your wish list, like the Santa's wish list of like top funds you want to get into, right? The biggest difference after that is like everyone can say they want to be LPs in NEA, Sequoia, NFX, IVP, some of these firms, which you're in as well, some of them which you're in. How does one think about access? Because did you have a pre-existing network in the US with these large funds? And how do you think about that?
That's a great question, David. We didn't have any network in venture capital before we started our firm, but we did build a very strong network during these 10 years of doing venture capital. So I will tell you how we started the network. So we got to get into a deal in the US. We invested in a company together with Foundation Capital, Revit Capital, great funds.
Phenomenal funds.
Through a good friend of mine in Mexico. He got an allocation for that specific deal. And I asked him, please allow me to do it directly. For us, it's important to do this thing directly. And he was generous enough to do it. And when we invested in that company, I asked the CEO of that company to introduce me to the other investors.
Yeah.
And I started asking for introductions, and I was coming to San Francisco like 6-7 times per year and spending a couple of weeks there, meeting people, talking to people with funds and then with companies as well. We were coming with and this is, I think, is very important, not only in the venture capital level as a GP, but also as an LP. We were coming always with a added value proposition. We were not just putting money, and we were representing and we were creating opportunities for these companies to do business in Latin America. And if you are solving a relevant problem in the world, in one part of your journey, you think of doing globally. And Latin America is a interesting part of the world, closer to the United States, same time zone, and having somebody there to help you navigate a difficult business environment, and with the backing of these big and important corporations, that was our pitch for getting first meetings and then the possibility to invest in those companies. But I remember when I was living in China, they have a very great culture or behavior. Every time they go to a meeting, they go with a present. And this is very strange in the States. But for the first 5, 6, 7 years, every time that I was going to the United States, I took one of my luggage and I packed a lot of the best quality Colombian coffee I can get. And every time that I was going for a meeting with a GP, I was coming with a bag of the best coffee in the world as a present. So they always remember me as the guy with the coffee bag, And at least because I knew that how many, David, how many meetings does a GP, general partner in a fund like this type of funds have per day? So I was like, okay, let's do something that at least I can, when I do the follow-up email, I can say, how was the coffee?
Yes.
And this is the guy who brought me coffee.
Yes.
And it's great. So I start doing this, but there is something in the Silicon Valley culture that is not because of the Bay Area. It's something that is not geographical. It's this state of mind that people will always give you the first opportunity. They will open the door always for the first time. And if you come up with something that is interesting, and if you prove yourself, then they can continue working with you and helping you. And this for me was amazing. They were, as an industry, they were very open to hear what we were coming to say. We knew the industries very well because we were really close and deep with our corporate partners. And then when we started investing in the companies, we started helping them to do business in Latin America. So we were fulfilling what we promised. Right. In the first conversation with the bag of coffee on the table. And they saw us. They saw us pioneering something, hustling, working hard. So when we came after 10 years of doing business with them, we say now we switch strategy. We have this new strategy of the fund of funds. Will you allow us to put some capital, very small tickets in your next fund? And most of them say, of course, you have shown that you are great partners for us and our companies, and we will continue to work with you and support you right now that you are pioneering a new area of venture capital in your region. So this is how everything started.
I love how thoughtful you are about all this. And it is so smart. I'm still it's still going in my head. I was like, oh my God, I've got to bring like some kind of gift to like these things as well, because for better, for worse, like as an individual LP, I'm a much smaller check size than so many other capital allocators out there. And it's really good to be able to live rent free in someone's mind and to be able to give that bag of coffee and then have a very natural follow up of like, how was the coffee? And let's be honest, most people are coffee drinkers and everyone knows Colombian coffee is really good coffee. It's two questions. One, and this is asking selfishly, but also asking for my friend who I know is a huge coffee drinker, good friend of mine, Andrew Ray. We used to work together at On Deck, but now he's starting this company called TaxWire. He drinks like 5 cups of coffee a day, which is insane and all that. What was the brand of coffee that you were bringing?
Yes, it's a local brand here called Pergamino.
Pergamino.
So maybe you can
how do you spell Pergamino?
PER GAMINO.
Oh. My dyslexic American brain would have called that Pergamino, but I'm glad you spelled it.
So this brand is a local brand that has won many awards. And we know the founder started like a startup. Now they are doing really well, but they have origin coffee. And I remember the first coffee that I was getting was coffee from their own farms. They have been coffee growers for more than 100 years.
Wow.
And I was bringing this specific type of coffee. And this is a great brand. It's a great coffee. They have coffee shops. They have brands. They have products. And now they have different varieties of origin coffee out of Colombia.
This is great because I don't know if I told you this. The name of my blog is Cup of Joe, and there's a natural lead into every so often I recommend a cup of coffee that I really like, and so this will go up there. I need to go look into this. This is phenomenal. And so the flip side of this is I want to talk about the family office, and this is a question I asked earlier, but the family office side of the Latin American LPs. What do the typical interactions look like, and how does one go about discovering what kind of family offices exist or are open for business in Latin America?
So, David, the family office business, I think that is still very early in Latin America. You can see families that have created wealth because of their operating business in the region, and they do invest in different assets, but becoming like a structured and professional investor and have a whole group of people specialize in different asset classes and making the right decisions and the way the decisions are made, this is still a work in progress. Also, we do have in Mexico, here in Colombia, a couple, in Peru, in Chile, of course, very sophisticated family offices. But I will say that there are very few of them, but the vast majority are either starting to create that practice or they are just family making tickets. That is not the same as family offices.
Right, right.
Or people making tickets. And so if you want to come to the region and raise funds, is somehow difficult because the level of understanding on the different asset classes, the way they make decisions is totally different. And I think that you need to have a combination and that flexibility to be able to talk to different type of investors and create a product that will be attractive and will be interesting for both of them.
Right.
So, and we also have high net worth individuals that put a capital net. One of the things that we come up with this first fund of funds is we cannot, besides doing a great diversification, we cannot change the risk return profile or the risk profile of the asset.
Mm-hmm.
It's venture capital. We cannot change the illiquidity nature of the asset. Building a great company takes time, and being in a fund takes longer than that. And a fund of funds is even longer.
Yes.
So this is something we cannot change. The only thing we can play with in that sense, with the minimum ticket size.
Uh-huh.
So in this first fund, we made the decision of doing a very small, a very low minimum ticket size to allow people to make to make the decision easier.
Right. To get their feet wet.
Yes. And so they can start learning and understanding about the asset class. The other thing that for us is important is that we are very close to our LPs. We are all the time telling them what's going on, trying to educating them in the right way, exposing them to what we are seeing. So they are learning, and we are cultivating those relationships so we can bring them very naturally to dedicate more capital into the asset class, because it makes a lot of sense for any family office to have a portion of their portfolio in this asset class.
Yeah. What does, actually, now that you bring that up, like, what does communication look like between you and your LPs? Like, how often, what is the frequency? Do you host events for them? Like, what does that look like?
So what we normally do is that we do a quarterly call where we normally tell them something about the industry, what's going on with the industry. We go and we see how the portfolio is doing and how the fund of funds is making new decisions. What is the pipeline? What are we looking at? What we are excited about? What other funds we have passed on? And we always try to talk about the companies in the funds that we are investing in, because we think that it's very abstract to think as an LP in a fund of funds that is an LP in a fund, and you lose the perspective of where the money is really going, and
right.
It's to fund and to support these amazing companies creating these magical technologies that can change the life of the planet.
Right. That makes sense. So
and this is very interesting for them. So then we also have periodically publications in our blog.
Mm-hmm.
When we do research,
Substack,
also in Substack, but we also do research only for our LPs that we share with them, because we also do like a portfolio report or fund of funds report every quarter, and we do investor day once a year.
And what does an investor day look like, out of curiosity?
The investor day here is a little bit more complicated than in the States, but what we try to do is that we talk about the industry, about venture capital, what's going on. We continue with this educational mechanism of sharing information with the LPs about the asset class. In this case, for example, our investor day was last week. We invited through a video conference two managers of two great venture firms from our portfolio to talk about early stage investing, late stage investing. Then we talk about the portfolio, how the portfolio is looking at. We are right now at 55% of deploying our capital. So where we see the next potential investments. And then we talk about artificial intelligence, because right now We have 9 firms out of our fund of funds, or 9 funds. Almost 40% of the firms they have invested in is in AI. So it's something that everyone is talking about. So we invited one of the founders, actually the general partner of NFX, to talk about artificial intelligence. And James did an amazing job telling people in very simple words how he sees artificial intelligence. So think for a Latin American investor to hear about how a managing partner of one of the funds that is more active in early stage venture capital investment doing AI, how he sees the world. So that was very interesting. And then we brought 6 different companies, also through video conference or me explaining what they do, to showcase what they're doing. So in robotics, in healthcare, in biotechnology, in agriculture, so people know what they are really investing in. So it was very interesting, and people really like and really value this type of interactions.
And this might be getting too much into the specifics, but I guess this is why people tune into this podcast, which is like, how did you pick those 6 companies? Is it by the markups they've gotten? Is it by traction they've gotten? How do you pick which companies to highlight?
No, as you say, it's always very thoughtful. Even if we do a fund of funds, we do have a thesis of the type of sectors and themes that we want to, not to invest in, but our money or our capital to be exposed. And because in the fund of funds, this is something we haven't talked about. We still have the same mission that we started Veronorte with. We want to create a bridge to bring disrupting technologies to solve relevant problems in our region. Even with the fund of funds, we try to do that. So we want to invest in those sectors that we think could bring those solutions to our region. And through the venture funds, the venture firms, we want to have access to those companies and help them do business in Latin America. Remember that 30% of our fund of funds continue to be corporations that are interested in connecting with those technologies now in a more efficient way through the fund of funds. And when we go to talk to VC firms, the value added that we bring is that we can help their portfolio companies do business in Latin America. So we do have specific areas that we are interested in. So we chose those companies to showcase on these specific areas that we want to show that if those technologies can come to Latin America somehow, it will help solve some of the most pressing problems that we have as a region.
I freaking love it. If there's a theme for this, it's just like how thoughtful you are. And I'm learning so much and I'm going to listen to this recording a couple times just to make sure I fully encapsulate all the lessons here. But I've also held a topic at bay for way too long, which is the topic of portfolio construction. So maybe if last hard hitting question here for this podcast episode, I want to talk about portfolio construction here. And first of all, I'm deeply fascinated. Like ever since you told me in that we were at Asha Tea House in San Francisco, Kearny Street, for those who are looking for it. And when you first told me this, your fund strategy, your portfolio allocation strategy is separated into 3 categories. It's established funds, emerging funds, and then frontier firms, or like established, emerging, and frontier firms, right? And in other words, like the frontier firms is defined as emerging managers. So, and then also the breakdown is 60% established, 30% emerging firms, and then 10% to frontier firms. Hope I got that directionally accurate. Before we get into the thick of this, of how you even thought about that portfolio construction, what is the difference between an emerging firm and a frontier firm?
So we said emerging firm to not an emerging manager. It's not just a person or a couple of people. It's a group of people who are creating or intend to create a firm that will last in time. So they come up with a more institutional approach of how they do their business. So they want to create processes. They want to create the career path for the analysts to come up and become partners in the future. They want to create a brand. So for us, and when they are in the first, second, or third, fourth fund, those for us are emerging firms. Rich capital is an example of what we call emerging firms, not managers, as you really noticed. NFX continue to be an emerging firm. They are consolidating an amazing brand, an amazing firm with very solid pillars, not only in investing, but in research and in technology. On the other side of the spectrum, we have the established firms, the IVPs or the Menlo Ventures or the Sequoias, or, those guys who already have even generations transition of investors in their history. But for us, a frontier had different dimensions. One is a solo GP, and it's a frontier for us because there is a lot of risk on that. Mm-hmm. So it's not just they could have a lot of experience of doing this, but they continue to be a solo GP. So there is an extra risk of investing in a solo GP. Uh-huh. Or this is a first-time fund manager. So he's coming for the first time, he's testing himself, and then there is also more risk there. Or are specific firms, normally they're very early on firms that are doing something very, very on the edge of technology. So if you can find, for example, it's impossible to find an established firm in crypto. Yeah. Or in climate tech. There are some that have some more experience, but you don't find a Menlo Venture that with more than 45 years of experience in climate tech or in crypto or in quantum computing. This is something new. Right. So we have different type of understanding of what a frontier could be, but it's more related with the way we see the risk return profile of these firms and also what we want out of these firms in our portfolio construction strategy.
Gotcha. Is it fair to say that the difference between emerging firms and established firms is that for established firms, they've gone through a couple, at least one or two cycles of new GPs, like they've gone through the changing of the guard, so to speak, versus emerging firms, even though like James, let's say from NFX, right? He's been there since the beginning, effectively, and it might be emerging in many ways just because they're still building out what they're. I don't want to speak for NFX here, but like what an analyst that gets promoted to GP that takes on potentially NFX after James retires looks like. And is that when someone graduates from an emerging firm to an established firm?
Yes, for us, emerging firms is a strategy. We want to create a firm. We don't want just to create a business for myself. We do have managers that are frontier managers that are doing the solo thing and they want to invest and they're amazing investors, but maybe they don't have in their mind to create a legacy firm, something that will transcend the time and continue to be a brand that you could see for many, many decades. This is something that you see in some other firms. As the example you were saying, we see that in NFX. NFX is thinking of themselves to build one of the best seed investment firms in the world. And this is how they are working very hard, not just doing great investment, but creating the process, creating the infrastructure, creating the culture.
It's too fascinating. There are a million other questions I can ask on that wavelength, but I want to talk about the breakdown of 60-30-10, which, I mean, in many ways you could say, like, why not 70-20-10? Or like, any of these other breakdowns. Was there rhyme or reason or science or art via 60-30-10, that breakdown when it comes to portfolio construction?
This would be a better question for Camilo, who is the guy who came out with the portfolio allocation strategy. But of course, we discuss it internally, not just among us, but between us, but also with the rest of the team. And the reason is that from the risk return profile that we wanted for this specific fund of funds, we wanted to be able to bring a good portion of established firms where we can see the track record and we can see the lower variation of returns.
Mm-hmm.
Still a lot of, dispersion in returns in venture, but can give us a better idea of how the returns of the fund of funds will look like, and give the fund of funds like a solid, base out of these established firms. There is another reason for that, that I have also to admit, and it's important. And as you asked me before, this is an assets class, not an asset class only. And to show access, you need to bring these established firms as well. Yeah. It's not that we will invest in any shiny name. No. And we have passed in amazing firms that have an amazing brands because they won't fit in our strategy. But we would like to show that we do have the access, because this is what we are selling to our LPs. You can have access to amazing firms, great assets through us. So that is the secondary, I will say, role of the established layer. Then we have the merging, when we see better returns, less track record. Yeah. But those are firms that are coming with emerging themes, that are the new kids on the block, also evolving the venture capital practice. And we like that. We like that a lot. And then we put this 30% of emerging firms. And we want to capture also this, I will call it alpha of the frontier funds, and start building relations with those guys. Because David, one thing that we haven't talked about it is the advantage of being small. We do small tickets, and it's easier to allocate in these very competitive funds when you have the right access, the reputation, and they have seen you working in so many years. But when you want to allocate more capital and to put to work more capital, it's going to be complicated, I think. So we also need to cultivate the relationship with the coming guys in order to be able to create larger allocations in the future in these funds, because we also pretend to grow our assets under management with the new fund of funds that we will raise in the future.
For some fund of funds out there, I see a lot of, if I might call it this way, graduation rates, right? In the sense that they only do, let's say, fund ones, fund twos, and this is likely in your thesis, like the frontier funds, so to speak. Solo GPs doing their first two funds, smaller checks in general. But then after fund two, they would graduate from that fund of funds to their LPs. And so, like, by some definitions, like, the graduation is part of it. But it sounds like for your strategy, or for Veronorte's strategy, it ends up becoming like the frontier folks will graduate into the emerging firms, and then the emerging firms will graduate into like the established firms. And that bucket, that set of puddles that people jump back and forth, will always just increase in size over time, and as long as you can underwrite it to a reasonable degree.
And we will be able to allocate more capital in the same buckets, I will say. Yeah. In the future, we will be designing, for example, funds that are more leaning into emerging managers and having some more risk, but also expecting more returns. The other thing that we are looking at is co-investing. That is very important as well, not just for returns, but also to modify the J curve for the fund of funds. So this is something that already is opening up opportunities to co-invest with the firms that we have in the portfolio. We feel very comfortable of doing that because we were direct investors before, and in that stages, Series B, Series C's. So we are eager to continue advancing in our fundraising strategy, so we can also dedicate part of the fund of funds to do direct investment into companies.
Felipe, not to like this is. I wish I had like 2 more hours with you, and I'm sure our audience will. I wish like we had like 2, 3 more, 5 more hours. We should just do an investor day where it's just you speaking on stage. And I'm sure like this is why your LPs love you. But to like come to the back half of this and to just like paint a little bit, like go back to things that are not LP VC stuff, but also what I call quick fire round questions until I figure out a better name for that section. I'm curious, for you, in the process of doing homework for this conversation, and you can correct me if I'm wrong here, but I may have stumbled across your Spotify playlist. And in that search, and feel free to set the record straight here, you may have an alter ego or a twin brother or something, but it says Felipe Valencia, and then it looks like it's your face. But as someone who has saved playlists from songs to sing in the shower to rock and Espanol to 1001 songs you must hear before you die, do you have a go-to playlist when you're traveling between the Americas?
Actually, I think that if you see my Spotify in the last couple of years, will be all children songs, because I have a 3.5 years old daughter and a 7 months baby. But to be honest, I don't listen to music when I'm traveling on the plane. I was blessed with the capacity of sleeping since I get into the plane until I get to the destination. When I was living in China, David, right, I was able to sleep all the flight from Beijing to Paris.
Holy cow.
Then I had to put my alarm clock,
right, in
order not to lose the flight from Paris to Bogota, because I will be sleeping also in the lounge. And then I could sleep the other 10 hours for the Paris to Bogota flight. I don't know. I get into a plane and I fall asleep right away. So, and I think it's great because I come full of energy whenever I land. And if I'm not either reading or working, normally most of the time I'm sleeping. Yeah. What I have been doing lately is that I'm downloading podcasts, and I do listen to podcasts, but not to music.
Well, first of all, being able to sleep anywhere on a flight, no matter how long, is a superpower. And the second of which, I'll change the format of the question a little bit. What podcasts have you worked into your rotation?
Oh, okay. So I listen to All In podcast every week.
It's a good one.
I like the Lex Friedman podcast a lot.
That's the whole flight.
Yes, that's the whole flight. And I listen to local podcasts here with the Colombian reality or Latin American politics. I like politics a lot. I like to hear about technology, so I also hear about podcasts on technology. The small, 20-minute VC or 20 VC podcast I also like.
It's no longer 20 minutes. Harry Stebbings, I'm sorry, Harry, if you're listening to this, you're no longer 20 minutes. I love your episodes, don't get me wrong, but it's no longer 20 minutes.
Yeah. But they're short because now podcasts are becoming longer and longer. That I like a lot. You need more time, but you can go deep into the conversation. And this is great because then you start finding these jewels when you are ready, when you're asking questions and coming back to different themes. So this is interesting. So this is more or less what I'm listening right now.
That's freaking amazing. A lot of which I'm familiar with. Probably not the Latin American ones in the politics, because I need to brush up on my Spanish in order to do that. We were joking, Felipe, you and I, right before this, there was a podcast that you went on, I think back in 3 years back or something, that was completely in Spanish. And what I ended up doing just to do homework for this conversation, I just had Google Translate next to you talking on the podcast just to make sure I was getting the context, and then let's see, to see if I was catching anything or missing anything. Okay. Last question here. From living in Berkeley to working as a commercial attaché at the Embassy of Colombia in Beijing to embracing research in Germany, do you have a single piece of advice for the wanderlust that has disproportionately helped you better appreciate and empathize the variety of cultures you've seen?
Yes. David, one of the most important skill, if you call it a skill, that you need to develop in this industry is the capacity to network and to create relationships. And I believe that those relationships should be genuine relationships, not just business oriented, and to try to build friendship beyond just business relationships. And I think this is important. This is the way I feel. This is what I like to do. I really enjoy my job. I like the people I have to deal with, or I want to deal with, because everyone is doing so interesting and amazing things. But the best way to do it is by talking to people, sharing experiences, but sharing part of your lives. It's like not coming up with something that is somehow synthetic or it's like, this is something I have lived. This is what I think, and this is why. And have been lived in so many cultures and places gave me the possibility to talk to almost anyone and listening to them and get to connect with them in a very specific way and share real experience of life. And I think this has helped me a lot to build this network that is a very important asset for the job we do, but also to create friendships with people that I really admire and I really like. So it's like a double side benefit, not just for job and for the professional life, but also for creating new friendships. Actually, I have spent birthdays in the Bay Area while working, and I'm very happy that my last birthday that I spent in the Bay Area, there were more people coming to celebrate than what I can bring when I'm here in Medellin. So I have created very good friends and very, very strong relationships and friendship with the people in the industry in different places in the world. And I think it's part of my baggage of having spent a lot of time living in different places with different cultures.
I wouldn't call that baggage. I would call that strength, superpower. That is phenomenal. And even if if people can tune in, like obviously earlier in this episode, you shared that the fact that even like bring really good coffee from Colombia to GPs who are out here in like the Silicon Valley, Bay Area, United States kind of thing goes a step further because let's be honest, I don't know how many of you've received. I've received a lot from GPs who are like, hey, I want to send you something, right? And I get the send thing, and it ends up just becoming a postcard. And it's like a very templated postcard. And nothing wrong with the fact that I'm still on that mailing list to get that postcard is nice, but that something physical and something thoughtful like goes so much further.
Absolutely. And when it comes, not just it comes with a meaning. So it was not just the bag of coffee. It was a story behind it. It's part of our culture. It's a little bit of Colombia or our city in a bag. And this is what I wanted to do, is something with meaning that tells a little bit of where I'm coming from.
I love it. I said it earlier. I wish I had another 2 hours. I wish I had another 3 hours. We should have just done a Lex Friedman style kind of thing where we just talk for 8 hours. But I got to let you go. I'll be cognizant of time here. But as one last thing, for people who want to find out, learn more, LPs, GPs wise, who want to reach out to you, where's the best place? Because you're in a bunch of places, but would you prefer email, LinkedIn?
LinkedIn is the best way to connect. I don't use Twitter. I don't have Instagram.
Maybe they follow you on Spotify.
No, but also email is Felipe or Camilo, because it's my partner, at veronorte.com.
I love it. And for those who are not blessed by Spanish genes like me, that's Veronorte, veronorte.com.
Yes, veronorte.com.
Felipe, I appreciate you. Thank you so much. I've learned personally so much about the Latin American market from you, how to think about portfolio construction, how to be just a thoughtful individual. And so I really, really thank you for your time.
David, thank you very much for having me, and hope to see you next time that I'm in the Bay Area. And this is more than that, and this is great about this business. It's a people business.
I want to give a special shout out to today's sponsor, Alchemist Accelerator. Backed by the likes of Coastal Ventures, Mayfield, Salesforce, just to name a few, Alchemist is the top B2B startup accelerator that's been around since 2012, backing founders from day one. And if you've been around for 12 years and running laser focused only on one industry, you build this incredible set of flywheels, and positive feedback loop is absolutely insane. We back the best enterprise talent who go on to change the world in which we live in, who then come back to their hometown, coach, and mentor the next generation of world-class enterprise talent. And don't take it just from me. Alchemist has backed the likes of LaunchDarkly, Rigetti, Privacera, Mo Engage, Farmwise, just to name a few, many of which who have come back as mentors and coaches for the current classes of Alchemist. If you're curious and want to get more involved in the Alchemist ecosystem, check out alchemistaccelerator.com/superclusters. That's an S at the beginning and S at the end, and we'll include the link in the show notes below. Till next, stay awesome. Hey Superclusters fans, David from Post here, and if you're tuning in from Spotify, Apple Podcasts, or wherever podcasts find your ear, it'd mean the world to me if you left a review. For those from the YouTube universe, let me know if you agree or disagree in the comments, and it'd mean a lot to me if you could share this episode with just one other person who'd get a kick out of today's topics. I'm on the road to publishing to at least 100 episodes of Superclusters, so every comment, question, review helps me make this experience more helpful, exciting, and fun for you. And lastly, I want to share a quick disclaimer. The views expressed in this episode are for informational purposes only and are solely the views of myself and the guest alone. They are not representative of Alchemist Accelerator. None of the views expressed herein constitute legal, investment, business, or tax advice. Any allusions or references to funds or companies are for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor prior to making any investment decisions. And that's all from me. See you on the next.